Good afternoon, ladies and gentlemen. I am Nirav, moderator for this conference. Welcome to the conference call of Aptus Value Housing Finance India Limited, arranged by Concept Investor Relations to discuss its results for third quarter and 9 months ended December 31st, 2021. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. At this moment, all participants' lines are in listen-only mode. Later, we will conduct a question and answer session. At that time, if you have a question, please press star and 1 on your touch-tone phone keypad. Please note that this conference is being recorded. I now hand the conference over to the management. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, good afternoon to all of you. I am Anandan, Chairman and Managing Director of the company. I welcome you all to the conference call to discuss the financial performance for Q3 and for 9 months ending December 21. I have with me Mr. P. Balaji, ED and CFO, and Mr. G. Subramaniam, ED, Chief of Business. The results and the investor presentations are available on the stock exchanges as well as in our website. I hope everyone had a chance to look at it. As you know, we are currently witnessing the third wave of COVID-19, which has spread at a very fast rate as compared to the previous one. However, thankfully, the economy was not as badly affected as it was in the first two waves. As far as Aptus is concerned, we've had a healthy third quarter and 9 months period, which is reflected in our results. Disbursement and collections are back to normal levels. Total disbursement stood at rupees 454 crores in Q3 22 as compared to 406 crores Q3 21, up by 12%. Disbursements for the 9 months was at rupees 1,122 crores compared to rupees 895 crores in 9 months 21, up by 25%. Happy to report that AUM as on 31st December has grown up to rupees 4,805 crores, representing a healthy growth of 27% year-on-year basis. NIM for the quarter was higher, was at 13.43, representing an improvement of 103 basis points compared to Q3 21. Gross NPA was at 1.53 after considering the impact of RBI circular dated 12th November 21. Our GNPA, without considering the impact of RBI circular, was at about 1.14% only. We have registered an ROA of 7.82%, which, as you are aware, is one of the best in the industry, and ROE of 14.12%. I would like to reiterate the fact, as I did in our earlier call, that we have enough on-balance sheet liquidity, which currently stands, which was at around 833 crores from December, including an undrawn sanction from NHB to the extent of rupees 400 crores, which we are likely to draw next week. Our net worth stands strong at over rupees 2,800 crores, which indicates robust capital adequacy in order to support future growth. The highlights of 9 months FY22 performance being disbursement for 9 months growth about 25% year-on-year. AUM at about 4,800 crores, grown by about 27% year-on-year, and the PAT at about 260 crores, grown over 36%. Our GNPA, as I mentioned earlier, is 1.53% after RBI circular dated 12th November. Our ROA at 7.82%. Our ROE, as I mentioned, is 14.12%, and sufficient on-balance liquidity, including the undrawn funds, is available. And the net worth of the company, as I mentioned earlier, is about 2,800 crores. I now hand over the line to Mr. P. Balaji, our ED, and the CFO to discuss various business parameters. Thank you, ladies and gentlemen.
Thank you, sir. Just to give some snippets on the business update. As on 31st December 2021, the total live customers was over 77,000, which represents a growth of 29% year-on-year. The total number of branches were at 202. There was an addition of 12 branches in the last 9 months FY22. Employee count was at 2,107. Disbursements increased 25% year-on-year to 1,122 crores in 9 months. AUM grew by 27% year-on-year to 4,805 crores. As on 31st December 2021, our NIM was at 13.43%. Our OpEx to average assets were at 2.61%, resulting in a healthy ROA of 7.82% and ROE of 14.12%. We have well-diversified borrowing profiles. Our borrowings comprise of 51% from banks, 27% from NHB, 17% from DSIs like IFC and large financial institutions, and the balance is in the form of securitization. We have sufficient on-balance sheet liquidity of 833 crores, including the undrawn sanctions. Undrawn sanctions include 400 crores to be drawn from NHB and the balance from banks. We are happy to announce that during the quarter, our ratings from ICRA got improved to AA- from A+. This will help us in exploring more sources of funding and also will help in reduction in the cost of funds. Collection efficiencies during the quarter dropped marginally to 98.28%, vis-a-vis 99.7% in September 2021. Main reason behind this was due to the rains which were abnormal in the months of October and November. This has actually led to an increase in the 30+ DPD as well. However, we are confident of collecting the backlog in the ensuing quarters. Gross stage 3 assets as per the RBI circular dated 12th November 2021 was at 1.53%. It was 1.11% before the impact of RBI circular. 42 basis points is the impact on the GNPA because of the RBI circular. Further, we have strengthened our provision coverage ratio from 0.41% in March 21 to 0.89% in December 2021. The provision coverage ratio for stage 3 assets stood at 25.16%, and for stage 1 and 2 assets stood at 0.52%. Our PAT for 9 months stood at 260 crores, representing a growth of 36% year-on-year, and our Q3 PAT was at 101 crores, representing a growth of 19% quarter-on-quarter. As on 31st December 2021, our net worth was over 2,800 crores. With these remarks, I open the floor to for the question and answer session. Thank you all.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Prakhar Agarwal from Edelweiss. Please go ahead.
Yeah, hi sir. Just 3 sets of questions. To start with, when I look at your gross NPA numbers or stage 3 numbers, even excluding RBI impact, your number has gone up by around 30-32 basis points. What would you attribute this to?
No, You see, basically, there is some increase in our gross NPA, and also in our stage 1 and stage 2 assets, all put together. But this is not on account of any change in our business focus, product mix, or customer profile. In fact, if we really look at all the three stages, stage 1, stage 2, stage 3, there's been an increase right from COVID-1. Because if you can recall, in COVID-1, we had taken a very conscious call to give a low moratorium and actually nil restructuring. In COVID-2 also, we gave very modest restructuring and no moratorium. With the hope that we will be able to collect the EMI subsequent period. But then came COVID-2, then came COVID-3, and also came the RBI circular, whereby while broadly there is no significant change in our stage 3, but stage 1 and stage 2, the soft bucket continues to be slightly at an elevated level, because when the customers are able to clear the monthly EMIs, they were not able to clear the backlog in EMIs on account of COVID primarily. Now, as far as specifically coming to in terms of the NPA as on 31st December is concerned, in fact, if you can related point is really our collections in the month of actually in the second quarter, our collections are about 99.5%. But in the month of October and November, our collections have dropped slightly by about 1%, about 1.2% also, primarily because of the northeast monsoon was substantially higher and different, more intense in this period in the parts of the market. This unusual heavy rain to some extent has impacted collections a bit in the month of October and November. That's where our collections instead of 99.5 dropped down to 98.2 or so. But that is only in the month of October, November on account of this unseasonal rain, excessive rain. But then again, the collections come back to normal. From December we have touched about 99.4% again, and January also it is over 99.5, 100 kind of thing. So in other words, but for the small events that happened in October, November, there is no increase. There won't be any increase at all in our NPA, including stage 3. And the small increase that has happened, 0.3% also, is a shift from stage 2 to stage 3. But then, despite the RBI circular, our NPA is we will very closely be monitoring our NPA, and it will maintain at a good level.
So just a follow up on this. What will be your 30 plus DPD number as on December?
It was around 30 plus DPD as on 31st December was around 12.28%.
12.28. So despite whatever we have seen, that number is again
around 2 to 2.19% from September. The reason stated by CMD is the reason actually. That is why the backlog has got increased. We are focusing on the whole thing to get it done now. So that's it.
Perfect. Just one follow up on this again. You said that because they were customers and underlying customer for ourselves would be such that for them making 3 to 4 EMIs, cumulative EMIs will probably be difficult. So in that case, under current RBI regulations, shouldn't your PCR, which is currently at around 25-26%, shouldn't that be a higher number in a steady state basis?
If you look at the PCR on the NPA, it is at 25% on the 1.53%. Okay. So if you actually the NPAs, real NPAs have gone up from 0.81% in September to 1.11% in December. So in addition to that, whatever is the requirement as per the RBI, we are classifying it as NPA, and for that also we are providing 25% the provision coverage ratio, which actually is not required because these are paying customers. Actually, they are stage 2 customers. Because of the RBI definition, these are getting classified as stage 3. So if you remove that, actual provision coverage ratio for NPA that we are carrying is around 34%.
Just to add, again, if you really look at the past 10-year record of the company, there is hardly any write-off as bad debt. In fact, we are running the company with near about zero write-off. And whatever provision that we are creating is only an enabling provision, and to the extent whatever the debit to the P&L account of the provision is only an enabling provision. And there is no bad debt content at all in that. In fact, if you really look at our overall PCR provision has been, despite our good track record in terms of near about zero write-off, in the last 10 years, we had increased our PCR, which was, let's say, at 0.41% for all the three, stage 1, stage 2, stage 3 assets, company level. We had a PCR of 0.41%, amount-wise about 17 crores. That we have now taken it up to from 0.41 to 0.89, and amount-wise from 17 crores to 43 crores. So the entire 43 crores is really an enabling provision only.
Sure. Just one last thing on operational side. So if I were to just look at your margins, there was a 20 basis decline on a sequential basis. But when I look at your NII, that number is up by 14% on QOQ basis. What would that disconnect be? Your AUM growth is somewhere close to around 7%. So what would that difference be attributable to?
No, the spread which you have told, which is 20 basis points decline, it's basically because there was a slight increase in the cost of funds from 7.86% to 8% because we had to repay some of the NHB borrowing, which was at the lower cost. But this will come back to normalcy once we draw the 400 crores which we are going to draw in February.
No, also, see, there is a conscious call we have taken because of the reduction in the overall cost, including the funding costs and the operating costs, without affecting our ROA. We have taken a call to fine-tune our HL lending rates by about 50 basis points effective April 21. That's only for the home loan part of it. We had really gone for a conscious call. We have gone for a reduction in our HL lending rate by 50 basis points. Now that is the intent there is really to pass on a part of the cost reduction that we are getting through reduction in the funding costs and reduction in the operating costs to our core product HL in this case. So, while the NIM, at NIM level, it could have been there, you are at yield level, that small reduction is there, but at our ROA level, there is no reduction.
Thank you. Prabhakar, I'll request to come back in the question queue for a follow-up question. The next question is from the line of Ashutosh K. Mishra from Ashika Stock Broking. Please go ahead.
So, sir, I know, on an NPA front, you just described that few things which came out, and then that resulted into the RBI as well, RBI change in RBI methodology as well as increase in monsoon and other part of it. So my question is, sir, what type of changes in the business model you are going to take place? Because daily of the NPA, whether you will require to do something change on your operating front so that your sales staff and other sensitize the customer more on this front. So this is the first question, sir.
What is the change in business model you are going to ask because of NPA tracking?
No, actually, fundamentally, we are absolutely clear. There is our business model has been sort of very relevant, time tested, provides good large growth opportunities with a very good pricing power. Now, and absolutely we don't find any need to change our, business focus in any form. Because, as you will see, we are really, in a particular segment of the market, which is really largely in the tier 3, tier 4 cities, smaller home loans, small EMIs, for self-occupied houses, largely self-constructed, and there is a large underserved, unserved market. And we have specialized in our underwriting and, other methods of doing business, including the collection. So absolutely there is no need at all for us to really look at any change in our business model, either because of the RBI circular. RBI circular, yes, it only, as all of you know, one part talks about in terms of upgradation of NPA. Now it says that unless we collect all installments, we cannot upgrade. That's one. But fundamentally, it has got nothing to do with the our business model or the customer profile or riskiness of the customer. It is it is really in terms of the way a regulator wanted. In fact, they use the word clarification. It's not a new rule or something like that. So in other words, upgradation of the NPA. The second one is really in terms of the day-end process running. I suppose this will make us go closer to our collection and ensure that our collections are done slightly better. And that's about it. Otherwise, business model per se, credit profile of the customer per se, we don't see any need to change at all.
Okay. Sir, my second question is on your cost of funds front. So we are seeing the rating upgrade. At the same time, cost of fund in the system is going up. So in this scenario, where do you see your cost of funds spanning out over the next 12-month period or so? From here.
This rating upgrade came almost in the mid of December. So that is one thing. So this to get converted into reduction in the cost of funds will take some time. Over and above that, with the available cash as of September, we didn't draw more fresh borrowings in the third quarter. And what I feel is there is always as you all know, the interest differential between a AA rated company and an A rated company is almost 1 to 1.5%. So yes. Even if I don't get that 1 to 1.5%, the additional borrowings will anyway be between 0.75 to 1% lesser than what we are borrowing currently. Plus the additional NHB borrowings which has been given to the extent of 400 crores, which will be at around 6%, and it is fixed for a 10-year tenor. That is also going to aid us in the reduction in the cost of borrowing.
Okay, got it. And sir, on the growth front, what type of growth we are looking for the next financial year, and any new market or any market where you have entered last year, what type of opportunity you are seeing in the growth side?
Yeah. Typically, we will like to grow somewhere between 25 to 30% on our disbursements, and we will concentrate on the existing market where we are present. But we will also go for in this particular quarter. Also, we are planning to go into Orissa. So that is one new market which will go in this particular quarter. So this is, but more or less, most of the growth for this particular financial year will come from the market where we operate. That is Tamil Nadu, Andhra, Telangana, and Karnataka.
Just to add, our primary growth, we have closer to about 202 branches as on date. Of that, about 129 branches are with a loan book of over 31 crore. And about 51 branches with a loan book, average loan book of 12 crores. And about 22 branches which are added in the last 1 year, loan book of 4 crores. The growth will primarily come from, the existing branches where the 22 branches with a 4 crore average loan book, that will move to a 12 crore. And 51 branches with an average loan book of 12 crore will move towards 31 crores, average loan book of 129 crores. So in other words, there will be growth coming from the existing branches. Also, there will be growth coming through productivity from the existing staff. Not to speak about incrementally new branches and incrementally new staff. Of course, in addition to these existing 202 branches, now as part of our strategy to grow on a contiguous basis, apart from the, as you know, we are currently operating on 4 southern states. On a contiguous basis, now we started looking at 3. One is Orissa, Maharashtra, and Chhattisgarh. As a first step, we were planning to enter into Orissa, and the first branch should become operational in the next 2 to 3 weeks' time.
Thank you. I'm sorry to interrupt you. I'll be requested to come back in the question queue. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Malhar, individual investor. Please go ahead.
Hello, am I audible?
Yes, Malhar.
Yes, please.
Sir, the line for the participant dropped. We move on to the next participant.
Okay.
The next question is from the line of Arjun Bagga from Dolat Capital. Please go ahead.
Yeah, hi. Good evening, sir. So I had this question regarding the asset quality. So if we have a look at the 30 plus DPD number, over the last few quarters, that has been ranging between 8 to 10-12%. But given that the last few quarters have been impacted by COVID, and before that, if we look at FY18 or 19, the numbers were, I think, 3 to 5%. So what is the BAU level for 30 plus DPD, and by when do we expect to achieve it?
See, this, as you have rightly said, we had pre-COVID, our 30 plus was different, but we had, like what Mr. Anandan explained, we had this COVID-1, COVID-2, and also COVID-3, and we have other issues in this quarter 3, like unusual rainfalls in the markets where we operate. We have, this is the 30 plus and 1 plus DPD as you see in the slides. The normal, it will take about 2 to 3 quarters or 2 quarters for us to come back to normal levels.
I just want to go back, take you back to, the origin, in the sense that, as I mentioned earlier, in fact, before COVID, right through our stage 1, stage 2, stage 3, it's always been only around 4 to 5% only. Only after the COVID-1, our stage 1 and 2 has really gone up. Mainly because, as I mentioned to you, we have very consciously gone for a very low moratorium and very low restructuring, because we believe there's no point in postponing the EMI dues for a later date rather than collect it now. And but that that strategy is getting implementing is getting delayed, because after COVID, COVID-2 came in, COVID-3 came in. But having said that, our collections today, in fact not in today, in the last, barring this small period of this, November, October, November 21, our collections have always been higher than 99.5 to, closer to 100. So in other words, we are able to collect the regular installment. That's why our NPA stage 3 has not gone up. But 1 and 2, that bulge is there. That will get run down only when the customers come back to better than normal situation and are able to pay more than one installment. So the customer quality is good. Our LTV is one of the lowest. That's why our bad debt also, even today, is literally not there. But then the bulge in stage 1 and stage 2, that is 0 to 30, 30 to 60, that for the customer to pay in addition to the regular installment, one more installment is taking a bit of time because of these external factors, which, as we know, it will take some time. It will take about 2-3 quarters or more, depending upon how COVID situation is settling down.
Sure, sir. So would it be safe to assume that over the next 2 to 3 quarters, if there are no further disruptions, we are expecting to be taking this number of 30 plus down to around 4-5%? Is that understanding correct, sir?
No, there won't be any major change as far as our 90-day plus is concerned. NPA is concerned, there won't be any change to the extent. Our quality of assets, our write-off, our provisions won't get affected. But stage 1 and stage 2 will take more. Currently, they are at elevated level. It will take more than 2-3 quarters for it to come down, and will come down progressively only. But because today in stage 1 and stage 2, we are running at almost around 20% or so, 12% or so. Like the 30 plus about 12%. That will take a little bit of time. But it won't really move into NPA. It won't move into 90 plus.
To add to this, we will not be able to commit on the number as of now because it depends on how we are able to collect and how the progress is going to happen. That's the only thing.
Sure, sir. This is helpful. Just one data keeping question. Sir, regarding the write-offs, can we please share the number for Q3 and for 9M FY22? Like if we have done any write-offs?
There have been literally no write-offs.
Let me explain. Our average home loan size is around 8 lakhs rupees. Our average EMI is about 12,000 rupees a month. And our loan to value is only around 35 to 40%. So even situations where out of 100, let's say 95 they pay, of the 5, after repeated follow-up, 4 also they pay. 3.5 to 4 they pay. That leaves 1 to 1.5% of the customers, where we go and sit with them and talk to them and tell them, look, the property value is so much, and our loan is only 1/3 of that. If you are forced to go through the surpasser route, arbitration route, etc., the customer will be losing. So it is in their interest to settle the loan. It is in their interest to sell the property and give us because otherwise if you bring it up as a distressed sale, the customer will lose. He won't get the market price. And this negotiation, this discussion takes place, and most of our customers are able to see the logic in this. Because this is one which is a difference between us and the funding for the apartments in metros. Because if you fund for apartments in large metros, you tend to fund up to 75-85% of the loan to value, and the customers won't be, in case of default, the customers won't be able to really settle that. But this is a different here, because in type 3, type 4 property, the value also depends on the land rather than the building part of it per se, and our loan to value is low. I mean, that's not only for us, even a couple of other of our competitors, leading good ones, they're also going through the same experience in terms of their actual write-off will be less because of this nature of business and the nature of customers.
Just one point to add, as you are aware, we have a centralized underwriting of the files, and all these 10 years we never had any fraud losses. Normally fraud losses are the biggest loss which happens in the housing finance company. and we don't have a fraud loss, and we only fund residential property, and most of it is self-occupied. And very important thing, it's all registered mortgage, so our name will figure in all the EC. So because of all these 10 years, we never had a fraud loss, and that is one of the big reasons the write-off is almost nothing.
Sure, sir. That's helpful. Thank you.
Thank you. The next question is from the line of Avinash Tanawade from Dalal & Broacha. Please go ahead.
First of all, thank you for the opportunity, sir. Can you mention your Tier 1 and Tier 2 capital?
That is too high. No, it is 76% or so. We don't have any Tier 2 capital. It's Tier 1 entire thing. Because you see, today on a book size of about 4,800 crores, 2,800 crores is our capital and reserves, our net worth. So because of, and also the risk weightage for all our loans are less than 30 lakhs. The risk weightage computations are different and lower for this class of assets. And because of that, we don't have any Tier 2, borrowing. But Tier 1 capital is very high. It's about 76% or so.
And what is the RWA number at the end of 9 months FY22?
Repeat the question, Avinash.
Risk weightage asset number, RWA.
No, risk weightage, what happens is, I don't have that number immediately. What is happening is for all the housing loans, suppose if I am disbursing 100 rupees worth housing loan, the risk weight attached to that is only 35%. So that's the way the whole risk CRAR is computed.
And for business loan, other loans, other than
the non-business loans which are getting booked under the housing finance company, it will be 100%. So that will constitute around 35% of the total housing finance company's book.
Okay. And sir, what is our average fees what we charge for every loan we disbursed?
No, repeat the question. I was not able to hear you properly.
Average fees we charge per loan.
Average?
Fees.
Processing fees is around 2%. We charge 2% per yeah.
Okay.
Yeah.
That 2% also we charge for the proposals that are sanctioned.
Yeah.
Not for any, otherwise we don't charge anything.
Come again, sir?
This processing fees is charged only on the sanctions, not on the login.
Okay, and that will be upfront, right?
1% is charged upfront, 1% at the time of disbursement.
Okay.
Yeah, thanks.
And do we see any? So we hardly saw any kind of write-off in a 10 years history. So we how much? So what is the period where we keep our GNP in our portfolio?
I'm not able to hear you properly, Avinash, if you can talk clearly. Yeah.
Okay, so average. Okay, I will ask you in detail.
Yeah, you come back to the queue after. Yeah, thanks.
Okay.
Otherwise, I'll call you. I mean, already we had a call, right? I'll call you to explain. Yeah, thanks.
Thank you very much. The next question is from the line of Kunal Shah from ICICI Securities. Please go ahead.
Yeah. Hi, sir. Couple of questions. Firstly, in terms of the overall ECL, given that collection efficiency is improving now, would we tend to maintain the coverage ratios at the current level, or if there is unwinding of the NPLs which are going to happen, it will reflect in terms of the provisioning release as well, or we would want to take it up from 0.9% currently?
No, see, we most probably we will not wind it down because, as I mentioned, though there is no, this entire ECL provision is an enabling provision, and but nevertheless, as a conservative company, we would really maintain this provision and possibly even enhance it a bit more. Actually, you are right. Even current year debit for the previous year 9 months, the debit to the P&L account on account of initial provision was around 3 crores, if I recall, 2.6 crores, if I recall, which has now gone up to 24 crores. So to that extent, my bottom line has come down by 22 crores this year, but it doesn't really matter because this is an enabling provision that is required, and and we would want to maintain these decent ECL provisions, for all the 3 stages, 3 NPA as well as the stage 1, stage 2. Also, we would want to maintain a decent level of enabling provision, and we would not go for any unwinding of this.
Sure. And of the rise in GNPA, excluding the RBI notification impact, which was 30 odd basis points, how much should actually unwind getting into the next quarter, given we are back to 99.5% plus collection efficiency?
Well, Kunal, actually, even if we ignore the, let's say, RBI circular, at 1.1%, earlier it is ready to 0.8, 0.5, 0.8 or 0.8 points, going up to 1.30 basis points more. You'll be, better. Our NPA at 1.1% is one of the lowest in the industry. Okay. If you can look at our nearest comparable, any competitors listed or unlisted, they will have much higher than this 1.1%. So I would say, given the, it will be around 1%. I think we will try obviously to go back to our 0.8 and all, but I would say it's about, it will remain about around 1% kind of thing.
Sure. And one last question in terms of LCR. So our liquid assets have actually come up to, say, 250 odd crores.
Mainly because we are sitting on this 400 crore sanction letter from NHB, and and that sanction, that information, the sanction we got a couple of months back, and we were not wanting to draw the other lines that are slightly higher cost and also a shorter duration. The NHB 400 crores is really, in fact, that we are planning to draw next week. Documents are executed already. And with that, we will move up to on-balance liquidity of about 833 crores, and that covers till up to March. In fact, on a monthly basis, if you see, there is only surplus only. So, and in fact, particularly after the upgradation to AA, there is no need for us to really to have a very high on-balance liquidity. So, there are some companies who are really still maintaining very high level of on-balance sheet. There's one company, keeping almost closer to 60-70% of their entire net worth is really in the form of cash or cash equivalent. We don't believe in that philosophy.
No. LCR norms which have come in for HFCs.
So, whatever you asked about this LCR, as of now, it is not applicable to us. Once it becomes applicable, we will follow the norm.
So, that's up the 5,000 crore cut off, LCR. Okay. Yeah. Sorry.
Come back to that.
So, yeah, because of this 5,000, it is not getting applicable. Yeah.
As of now, it is not 5,000. And that too, you have to look at
it.
So, as of now, we are not affected. But once it becomes effective, we will follow that.
Sure. Got it. Okay. Thank you.
Thank you. The next question is from the line of Franklin Moraes from Equentis Wealth Advisory. Please go ahead.
Yes, sir. Thanks for taking my question. So you mentioned in your presentation that 40% of your loans is new to credit. So I just wanted to check whether is it in value terms or is it by the number of customers?
It's value terms. It is 40% new to credit.
Okay. And just to understand, what is the strategy that we are pursuing in acquiring these new to credit borrowers?
See, we have alternative procedures where we verify the customers, including the business place, residence place, reference checks, and most in southern part of the country, apart from this loans he has taken outside, he has got, normally in this part of the country, chit funds are very popular. So he would have got chit funds like Magajasi, Sriram chit funds, Kabul chit funds, and other kind of chit funds. So from that we will be able to see what kind of savings he has taken, what kind of borrowing, and what kind of repayments he has done. These chit funds details doesn't come in your credit bureau report. So these are some of the extra things what we do there. Of course, our normal traditional way of what kind of assets he has created, what kind of business models does it fit in our standard business models and things like that. So these are the verification which is done for such kind of customers. Also, credit scorecard model which we have developed where we have got a set of points, and also we have got a standard 60 to 70 standard profiles which we have developed over a period of time, where we know this kind of business makes this kind of profit, this kind of repayments they can do, and things like that. So this credit scorecard plus this model of the 75 profiles helps us to check all those customers who doesn't have a credit history as such.
Okay, thanks. That's very helpful. And even going forward, will this ratio start increasing, or are we expected to maintain it at current levels?
This 40% will improve over a period of time, because now we see a lot of customers moving from local borrowers to organized financiers. So we can see customers having two-wheeler loans, customers having personal loans, gold loans, and things like that. So this percentage in future will tend to move up because customers also tend to take loans in the organized sector.
So also, as we, as our percentage of business keep slightly increasing in the tier 4, tier 5 cities, where they tend to, be new to the, credit. They may have small credit limits for the two-wheeler or used vehicle or some of them consumer loans kind of thing. But then for a long-term loan, home loans and all, they will be relatively new. So since our emphasis really on tier 3, not in tier 3, tier 4, tier 5 cities, that percentage will tend to slightly go up rather than come down.
So any guidance in terms of can we see this number going up to maybe 50% or so in the next couple of years?
Yeah, actually, even if it goes, our experience shown that, the credit culture is good actually, because, our lending norms are such that we check through completely. And then the other thing is that they, have a small house of their own in that they live among the community, and they really want to repay. They don't want to be seen as their homes being seized and all. There is a lot of emotive values there. There is a lot of family attachments are there and things like that, particularly in the tier 3, tier 4 cities. Then in metros.
And to add just a point, about 94-95% of our customers, will be their only home, and this will be their first home. So there is a huge emotional attachment to that particular property.
Okay. And so currently our self-employed share is 72%. But, with the economy opening up and, the self-employed gaining strength, can we expect this share to increase maybe in the next 1 year or so?
No, see, I think that our self-employed ratio of 75 to 25 salary, that will tend to continue. There won't be much change in those ratios. Because as we go further also, we will concentrate on our self-employed customers, because that is the area where they have mastered over the few years actually.
Also, in our view, the salary class are, in a way, is a commodity type lending, and where the pricing power is low and the loan transfer is very high. Whereas converse is the case in case of, self-employed, smaller, self-employed, living in tier 3, tier 4 cities. So where our, in fact, that's the reason why our loan transfers, if you see also, is one of the lowest. Despite the fact that our interest rate could be slightly higher, but our loan transfers, is lower. And, we've really chosen to operate in this segment. This is very, it is challenging to have the right tools for the credit underwriting, for legal, technical verification, and for collection. But if you master that, this is a segment which is, again, this is a segment which is somewhat, underserved, unserved, with a large market potential. So we would really, though it is challenging, but we would really see a very good opportunity for growth in this segment. To that extent, we would continue to be in the self-employed. That will continue to be around 75% or so. And our focus and emphasis will be more on the self-employed rather than salary.
Thank you very much. I'll request to come back in the question queue for a follow-up question. The next question is from the line of Malhar from NM Capital Markets. Please go ahead.
Thank you, sir. So first question is, what is our typical loan rejection rate? Like out of 100 loan applications, how many do we approve?
Yeah. Typically, in home loans, our rejection rate will be about 15%, and in the non-home loans, our rejection will be slightly high. It is 22 to 23%. And we are also very cautious in the non-home loans because we also know in this market it is very tight. So we have so many additional checks for that. So on average, home loan and business loans, if you put average, it will be about 20% rejection rate. And also some of the loans, we have about 7 to 8% of loans which might not be rejection, but it could be downsizing of the loan. Suppose he has asked for a 10 lakhs loan, he might actually be eligible only for 7-8 lakhs loan. So that kind of downsize is also in about 8 to 9% of the cases.
So totally in home loans, one can say about 15 plus around 7-8%, about 20-23%.
Yes.
In case of other loans, it can go up to 22 plus 8, around 30%.
Got it. And secondly, can you please elaborate on the data analytics? Like, I believe we are doing the pin code wise, sourcing wise, and the product wise asset quality check. So can you please share some details on this?
Yeah. On the data analytics part of it, we are using a part of machine learning and also the artificial intelligence. On the bounce prediction, what kind of bounces will happen in the future considering the regression model, so that we tend to reduce that. The more on the analytics piece of it, which you have asked the question, we also tend to see our what we have funded, how it has progressed, how was the repayment. And the repayment analytics are based on the profiles of the customers, the PIN codes, the kind of products, and there are about 7 to 8 data points where we verify what kind of analytics can be done. So once we fix this analytics, what kind of reasons, then 2-3 important things are then learning for us to avoid such kind of profiles in the such kind of reasons, the 8-10 data points.
Yes,
sir. So that gives you that feedback. We take it to our credit underwriting model, where we take it to our credit approval process, where this particular whatever conclusions you have come based on analytics, we take it to the credit scorecard. So credit scorecard has got about 12 to 15 basic parameters, which tells you that whatever you have explained, like profiles, PIN codes, sales executives, and all those things like that. So when you have this 15 scorecard, then we put onto that scorecard the new file which comes for a processing, and there we get a scoring where we can do the funding, not do the funding, or like what we explained, we can do the funding, but we have to do at a lesser loan amount, like downsizing. So these 3 conclusions will come. And we verify that scorecard model also with our manual model, which we have taken for all these 10 years, and we verify both these models and find out whether we can do the funding, and then we fund the customer. Second, one of the important things in analytics is that we also study customers who are paying very well. So that shows us these are the opportunities for us. So say, for example, any profile which is doing extremely well for us, because every company's data only they have to analyze for doing the future funding. One company's data will not help the other company. So we take that data and see maximize that opportunity for our future funding. So these are the two major things. One is that when you do a credit underwriting for new files, one is that credit norms per se changes. Third, wherever customers are paying properly, what kind of opportunity you see in the market.
So, sir, is it possible to share the findings like which product has the lowest NPAs and which sourcing stream has the lowest NPAs?
I feel that is very proprietary for us. We cannot share that actually.
Okay, sir. Fair enough. Thank you and all the best.
Thank you, Bala.
Thank you. The next question is from the line of Ankit Bansal, individual investor. Please go ahead.
You are now being in 4 states only. You are now moving to Odisha.
Sorry to interrupt you. Your voice is not very clear. May I request you to come in a better reception area, please?
Sir, now it's clear? Hello?
Yes, slightly better than
Hello?
Slightly better, but
you can ask. My question is, now you are moving towards Odisha. Sir, what is the USP of the company that will attract the customers to take loans from the company rather than other companies?
USP. The USP is that we have mastered a model for ourselves, like what Mr. Anandan explained about the self-employed customers. Many of our customers in the self-employed segment, as you are aware, in India doesn't have a proper IT proof, proper income proof or a proper salary slip. So we have got a clear model for about 75 profiles and also the other profiles to how to evaluate the customer who has got a good cash flow, but he doesn't have a proof of income. So that particular model we will evaluate, and that is the biggest USP for the customer. It helps them because very rarely without the proper IT returns or without the proper bank statement, most of the other financiers tend to not to fund this customer. So this is the biggest USP, and that is helping us and also helping the customer.
Follow-up question is that, sir, I'm clear about that. Sir, what is the future plan of the company that will make Aptus Housing Finance the biggest player in the market?
See, our future, we are very clear because, we will continue to be in the markets in the products that we currently operate, in the markets that we operate, in the profile of the customers that we operate. Because we believe that this is a large underserved, unserved market, particularly in the Tier 3, Tier 4 cities, for self-employed people who have genuinely in need of, loans, home loans. This is what, and we have really, our entire organization, systems, processes, culture, physical presence, nearness to the customer is all tuned to that. And we believe that we can really grow in our existing lines of business, existing products, going forward. One thing is that we may, as I mentioned, we may keep adding more geography on a contiguous basis as we go forward, because in this line of business, closeness to the customer and knowing the customers a lot more closely, both through personal touch, both at the home and also at the workplace, is important kind of thing. And also, a significant part of our business also flows, could come from the reference from the satisfied customers. To that extent, we would want to be closer to the customers and service them well. So, I mean, this is an important segment of the mortgage market, which according to us is, there are challenges in this market, but the market size is large and very genuine one, and that's what we wanted to be focused on.
We believe that, like what you said, satisfied customers, that is more important. That will give us more referrals and business in future, and that will serve as the biggest advertisement for us.
Thank you very much. Thank you all for being a part of the conference call. If you need any further assistance, information or clarification, please email balaji.p@aptusindia.com or gaurav.g@conceptpr.com. Ladies and gentlemen, this concludes your conference for today. Thank you for using Chorus Call conferencing service. You may now disconnect your lines. Thank you and have a pleasant day.
Thank you all. Yeah.
Thank you.